Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, May 3, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And tonight, we're looking at a chart with a different visual look. We're looking at some different lines. We're looking at a couple of different trend lines. So let's discuss exactly what this look is all about, what's going on, where we went today, and where we go from here. Well, before we really get going, there's a couple of housekeeping items. There's some good stuff in tonight's video. I have a laundry list of items that I want to go over and discuss, and I think they're good learning opportunities. I don't know if we'll get to them all, but I'm going to make my best attempt. The other thing is, again, thank you from the bottom of my heart for all the comments that you continuously leave about your views of the markets, asking questions. I'm happy to answer the questions. I like the interaction. It builds on the community, and a community is how we each learn. We learn together as a group. The power is in the numbers. So continue to make comments on the videos. Thank you very much. It's helpful. And thank you for liking the videos, and thank you for sharing the videos with someone that you think can benefit from this information. So please continue to do so. It's how the world goes around. It's circular. All right, so let's get back to the market. Now, tomorrow, keep in mind that we have, and this is Friday morning, we have the non-farm payroll report. Why they exclude farmers, I have no idea. But the point of the matter is we have the non-farm phony payroll report. Now, why I say phony is it's tongue-in-cheek. Now, they, meaning the government, has a formula, the Bureau of Labor Statistics. They have a formula that they believe works. And they believe that it's their job, their duty, to report the employment status of the country. How many people applied for unemployment? How many people are employed? What's the rate of employment? All these statistical things they feel the need to report to the public, but mainly to the financial community. Now, somewhere along the line, the market began paying very close attention to the release of these reports. It happens at 8:30 a.m. Eastern Standard Time. That's when the numbers come out, and for one reason or another, the market tends to gyrate around the number. The market may go up, and then it may whipsaw back down. It may take a dip lower to an extreme number, and it may reverse higher and open by the time the pit session or the regular market hours open at 9:30. We could be higher after a big slam down to lower numbers. We've seen that before in both directions. The point of the matter is that nobody knows what the employment number is. It's not a real number. The margin of error is way too wide for the number to matter. So if the margin of error is 150,000 jobs that they report, and they report 125,000 jobs, well, it could be a really, really bad number, or it could be a really, really fantastic number with the margin of error factored in. Nobody really knows what the number is, and then they come back a couple of months later and revise the number. So why we pay attention to this? Well, we don't, and that's really the point. The point is that who cares if the market pays attention to the number? We don't really concern ourselves with what the number is. We don't care how many jobs were created or lost in any given month. We care for the people that lost them, but we don't really care for the purposes of what we're doing here is reading the market. The market's going to react to whatever the number is, good, bad, or indifferent. And then our job is to figure out where the market's going, if the market's going to find a support level, find a resistance point, put in some kind of a pattern that we can derive information that says the market is going to have another leg lower or another leg higher. That's our point in following the market's reaction to the numbers. Okay, so what's the point of all that? Well, tomorrow morning the market can move in one direction or another as a result of the number. But we already knew that. So there really was no point other than I just wanted to talk about it. I thought it was important information. And if you haven't heard that information, at least presented in the manner in which I presented it, I think it's at least somewhat of value for those of you that may want to pay attention to a number. Just realize the reason we're paying attention to the number. We don't care whether it's a good or bad number. We just care what the market thinks about the number. So here we have some additional trend lines on the chart. So let's go through this and explain what we're looking at here. So really looking at a number of things at the same time. The first thing is, and I think this is well worth addressing right out of the chute, this is last Wednesday's low. Last night, we presented the importance of last Wednesday's low. It was an extremely important level that we had to maintain the market above on a daily chart closing basis. So you see what happened today. Here's the 200 period moving average. This has been holding the market up all this time. We've hit it a number of times, 7, 8, 9 times, whatever it is. We've hit it a number of times, yet we have not yet, other than 1 or 2 times, closed, if not for a split second, but we're not able to sustain closes below the 200 period moving average. So we closed maybe on it here, closed below it here. Every other time, we just ricocheted off the 200 period moving average, and today was no exception. But look at that in relation to Wednesday's low. So we talked about the importance of Wednesday's low. Here's Wednesday's low. It was beneath the 200 period moving average. We actually did take a dip down this morning, and while we're talking about this morning, we can look at the intraday chart, 10-minute chart. So you can see from this chart, the market gapped lower right here and continued lower. And at one point during the morning session, it was a pretty hard sell. So the market was selling off pretty hard, and they certainly had an opportunity to make it an ugly day. However, the market around mid-morning, I think this was around 11 o'clock in the morning, if I'm not mistaken, 11 on the button, the market found a bottom and reversed. Now, what's interesting is, and this is right out of the course at lazyemintrader.com. Now, here's the thing. So from the opening candle to the time the market reversed, would that have been a reasonable trade down there on the long side with a defined limitation of what your stop out would normally be? And the answer is yes, and the answer is taught in that course as to why. There's a couple of different reasons why. The more reasons you have why to take a trade, the higher the probability that trade becomes. Was it an easy trade? No, not by any means. Did you have a defined stop loss? Yes, you did. So in the event that this trade would not have worked out and would have been wrong, meaning the trader who took the trade would have been wrong, the stop out would have been reasonably close to entry, and that's how we lose small and fast when and if we have to lose at all. And we do have to lose. It is part of the business. Everybody knows that. Nobody wins on every trade. It just doesn't happen. So check this out. Then the market reverses and then proceeds to kind of find a high end of the range today and trade in a channel for a good portion of the afternoon. But what's interesting is when you look at the hourly chart, would the normal trader who just looks at short-term charts understand and know why the market traded to a specific area while it was on its way up? In other words, we would have had a target had we been long trading up to an area, and there were a couple of reasons to be long, okay, but we'll get into that in a second. But then also, the trader that just looks at short-term charts doesn't understand what the target would be on the upside and where the market would find a natural area of resistance. I'm going to show that to you, but first, let me explain a little bit about why a trader could have been long even for just the last push higher. And it was right in here, and anybody that's taken my course knows exactly why and exactly when this trade would have been entered. Now on the spider chart, in terms of pennies, it doesn't look like a lot. But if I just put my cursor here and say, I could have, would have, should have gotten long right around 262.40, give or take, for argument's sake. And I could have ridden it up to 263 and a quarter. Okay, and I'll show you why I could have ridden it up to 263 and a quarter. Now, in pennies, it doesn't look like a lot, but if you're trading the S&P E-mini futures, or some of you trade options, the weekly short-term options, that is a good move. That's a tremendous move in a very short period of time. That's how money is made. And that move right there is right out of the course. It's something I teach in the course and emphasize quite a bit. And by the way, when you look at this, this is a pattern that repeats over and over again. The trick is where to get long within the pattern, why to get long, where you're wrong, where does that pattern fail, coinciding with where to get in, when to get in for that secondary move higher. So all those things are extremely important to be successful trading that pattern. Now, here's the other thing. Here's an hourly chart. Now, remember when I said, why would you have expected the market to get to and then find resistance at a specific area? And when you look at where the circle is, when you look at where the market actually did find resistance, what you'll see is that the market found resistance as soon as it filled a gap. Yeah, absolutely. So the market went up and filled a gap. Now, from down here, you don't know that the market's going to get up here and fill the gap. But when you're long, and you're long for whatever reason you were long for, maybe you were long because the market got above the opening high of the day, the opening range high of the day. Maybe that's why you were long. That's fine. There were 3 or 4 reasons that one could have been long throughout the trading session, but how many of the traders knew that the market was going to find resistance where it did and were able to exit a long trade out of a position of strength, sell into the move higher rather than selling when the market's going lower because you think it topped out and you want to save what money you have left from the trade? That's a big difference, and that makes an enormous, enormous difference in your P&L each and every day, each and every week, and each and every month. You go ahead and review your trades, and everybody should be keeping some kind of trade log, trade journal, because we use it as a learning tool. And here's another side note. So when you log your trades, and you should all be logging your trades, and you go over them, do yourself a favor and start to log in the trades where you sold because the market was on the way back down, or go back to the trades of recent and just notate, go back to the chart and say, yeah, I sold here and it was on the way down. What would have happened if I sold into strength? What would have happened if I was more aware of what a natural area of resistance would be, when to sell into strength, how many extra pennies or dollars or whatever the type of trade is for you, how many extra points was I able to get, or would have I been able to get out of a trade like that, multiplied by how many trades? I'm here to tell you that has an enormous impact on your P&L statement. Think about, even if it was making up a number and say $50 a day. And I'm also here to tell you that that's a very conservative number. It actually comes out to a whole lot more than that if you actually do the math with your own numbers on your own trading log. It's thousands and thousands of dollars over the course of a year on just selling into strength versus selling because you're running away from the position on the way back down. So back to the hourly chart, you can see that once we filled this gap, what did the market do? It just petered out. It just ended up pulling back a little bit and then going sideways back and forth for the remainder of the afternoon. So after it hit the session high, that's it. There were no other long positions to be had after that happened. IWM today, a bit of a laggard, not by much, not enough to make a big deal out of it. However, you can see here that we're hovering right on these moving averages, slightly below these moving averages. If the IWM is obviously going to turn short-term or long-term bullish, back to the bullish side, and this really isn't a terrible chart anyway, but it's got to get above these moving averages. The longer we stay below the moving averages, the weaker this position will become on the daily chart and more susceptible to another move down. But you can make a pretty good case that this is essentially another ABC pattern. This is the B-leg pullback, and we take off from here, but it may be from down here, but this is still not necessarily an unhealthy daily chart. And while we look at daily charts all the time, look at the weekly chart. You can see here on the weekly chart, it's a bit of a different picture. So until and unless we're able to close above that level on the weekly chart, then there's nothing doing here. This is going to be and remain in a bearish pattern with pressure to the downside. And you can see our long-term trend line that really comes from the monthly chart that drawn in from 2011. We're below that, where this is the start of May. We finished the month of April below that. So there's a lot of stuff going on in the IWM. The weekly chart is a bearish pattern, no two ways about it. The daily chart, I can make a case that we can easily get a push higher out of a pattern like this. This is, really just a pullback pattern. But at the same time, the longer we stay below the moving averages, the more increasingly that the pressure will be to the downside for another move lower. And maybe tomorrow is the spark. Maybe the phony non-farm payroll report is the spark that gets the market moving in one direction or another. Either it gets the market moving to the upside, and I'm going to jump around for a second. Go back to the spider chart. I forgot to talk about these trend lines. I apologize for jumping around, but I think it's important enough to actually discuss. So, let's say the market goes up tomorrow. We're back inside of this triangle within a triangle pattern, and maybe we get to the upside, maybe we don't. But right now, then the point of this triangle that I drew with the lower trend line and the upper trend line is the fact that we got below this lower trend line, today, and when we rallied back, that's where we came up short at a retest of the lower portion of this trend line. And I think that's the fascinating part that I wanted to bring to your attention, because that's, when you look at technicals and you can draw trend lines. Now I can move this trend line around a little bit. It's a daily chart. It's not on the points to the penny exactly, but this is for, visual purposes. And for visual purposes, did we rally back to the underside of that trend line? And the answer is yes. Did we rally back to it to the penny, or did we come up 7 pennies short? It doesn't make any difference. The point and the concept is that we were pretty much a lot lower today, and we rallied back right to that trend line. That's the point I'm making. And the top end is, you can see here that as the trading went on since we made this bottom last Wednesday, we actually are creating another triangle that today we just broke below the bottom end of it. And I think I've showed you this part before, but the point is that now we have this that developed on the top end. And again, and I must emphasize this, as crazy as it might sound to realize that still this is not off the table. That's the level we were looking at. Anywhere this trend line falls with time and price together is where we would likely find another resistance point for this market. But remember, I said, and this is the point, that we didn't close below the low from last Wednesday. We got below it, and the market rallied back to it. Now we have another point of interest to contend with, this trend line right here. Are we going to get back above that, or is that going to be a rejection point for the market? That's certainly possible, and we can come back down tomorrow, but we have to take it one step at a time, and we have to take all the information that the market gives us and all the information that we can find each and every day on each and every chart, and we have to try and put it together in the most cohesive puzzle that we can create. And that's what I try and do each and every day. All these are different puzzle pieces that get put on the table, and they all are trying to tell us something. It's the one that can assemble the puzzle in the correct manner is the one that wins the prize. And there can be more than one that wins the prize. That's fine. I hope everybody wins the prize. But the whole trick is, can you assemble the puzzle correctly? Is this a trend line that's going to fail and send the market back down lower? And if I was 100% sure of that, I'd be sitting on a big position betting on that exact thing to happen. But I'm not 100% sure of that, and I'm not sitting on a big position anticipating that to happen right in front of the non-farm payrolls report. That would be akin to just walking up to a roulette wheel and, betting whatever number on, black or red or a number. It's just a bet, nothing more, nothing less. That's not what we're doing here. What we're doing is identifying the highest probability trade we can find. That's the one we go with. A trade that I'm willing to risk my capital in is a trade I'm willing to share with you. So to wrap this one up, the fact that we didn't close below last Wednesday's low still keeps intact. Some crazy reason we get up here after all this, it still keeps intact that C leg pushing higher of the A, B, which would end up to be B, and then C pattern. It's still not off the table until and unless we close below last Wednesday's low. Came close today, didn't happen. We'll see what happens tomorrow following the phony non-farm payrolls report. Now, we talked about the IWM. Really nothing new to add. You got the picture on the IWM. The VIX didn't really move today. The VIX had a spike right into the moving averages early on. When you look at the VIX and you look at a 10-minute chart, you can see what happened while the market was selling off. The VIX was spiking higher, but look how quickly we came down when the market rallied. And where are we? Right back where we started from at the beginning of the day. We spiked up into, through each of the moving averages and finished below all the moving averages, keeping this bearish pattern intact. The VIX is telling us that higher prices are coming, and hence that circle on the spider chart at the top end of the triangle all the way up near what was now probably 272 or something like that is not off the table as crazy as it sounds. The transports today. So the transports today come in and touch upon the 200 period moving average and rock it off. Now, you know my feeling about this 200 period moving average. It doesn't mean much. We've come close. We've come close. We've traded right above it for a very long period of time. It doesn't have any near the significance that it once would have had we touched and spiked through the 200 period moving average. You can buy with both hands, not having visited anywhere near that area anytime recently. But after teasing us over and over and over again, today was the day all of a sudden they finally spiked through the 200 period moving average, rocket higher, and now all we have is a bullish uptrend from here. I don't think so. I just don't see it playing out that way. Now here's the other thing, and here's where sometimes the market is designed to trick, trap, and fool as many market participants as possible. But here's one of those things where a trader can get fooled. We learn from wherever we learn it from that this is a tail candle, and there's other names for this candle, right? This candle from here today. So that's a tail candle. It's a doji candle. It's a pseudo doji candle. It's whatever you want to call it, whatever fancy name that some other person has given that type of candle. And I know that they're out there. I just don't use them. The point is that we learn that those candles are signs of a trend change, so expect higher prices from here. And that may or may not be true, and I have my own twist on that and obviously discuss it in detail in my course. But what's also interesting is it matters to me where they occur on the chart. And this one happens to occur in a place where I'm not buying the story. And everybody that's taken my course knows exactly what I'm talking about and why. And so we'll see. And certainly it can work out that we get an up leg from here. The market did come down for a, pretty long duration of time where it can certainly get a rally from these levels down here. And this could be the catalyst, meaning this type of candle can force some buyers in. And I get all that. That's fine. And it would be played in the IYT, which is the exchange traded fund that tracks the transports. But I'm just telling you the way I look at it, I'm not buying the story that today was a bottom. Maybe for a couple of days, but not a bottom in my book, not the way I'm looking at things. Not on this chart anyway. All right, so the financials. We'll go over to the financials. And here again, this is the XLF, and you can see here, now we're below the 200 period moving average on the daily chart. We had a pretty decent spike lower today, and we rallied back, and we put in a tail candle. And here we go again with the same tail candle. Did we make a new low, and the market, by making a new low, is now reversing higher? I'm not buying the story. Not right here, not right now. If anybody wanted to trade against this low, you can. Okay, and same thing goes for the transports. You can buy the financials here long, and you can buy the transports here long, and you can potentially expect a retracement, or not at all. We could just take off from here, or we get a retracement. You can buy the retracement. Either way, you can buy it against the daily close below today's low. That's the only way that you can make this trade. I'm just not buying that today was a low. Now we closed back below, or for the first time, below the 200 period moving average. I want to see evidence. Maybe we pop back above it tomorrow. That's fine. You can still trade it long against today's low if you want. It's just not something I'm willing to buy the story that today was a low just because it's a tail candle and the transport, same routine. We had an intraday reversal in the spider, but yet we rallied back up to a trend line, and we stopped short of that trend line. Is that enough mustard in the jar for the market? I don't know. Maybe we get the catalyst from the non-farm payroll report Friday morning. We'll find out soon enough. And by the way, the XBD, look what it did. it touched the 100 period moving average. Nice gentle touch, little spike through it by a couple of points, and then we proceed to rally right back above it and close nicely on the day, only down $2.87 or 1% when it was actually getting slaughtered earlier in the day. Now, again, you know, one could say, well, that's a test of the 100, off to the races, here we go, it's bullish. And maybe so, but to me, this is just a long consolidation on top of the 100 period moving average that will ultimately break to the downside. And if you're not sure about that and you want to go over to the weekly chart, what do you see? You see the same thing on the weekly chart, then you swap out the 20-week moving average for right around the same area as the 100-day moving average. But all we're doing is consolidating inside this bearish wedge pattern and just getting ready to what looks to me like break through on the downside, the 20-week moving average. Now, if that doesn't happen and we rally from here, then so be it. But I'm telling you that 7 or 8 out of 10 times, this particular pattern that we're looking at is going to play out to the downside ultimately, even if we have another rally for a week or two. As long as we don't close above here, this could take a while, but ultimately this is going to play out to the downside. That's what this pattern is telling us until and unless we can close a week, Friday close, above this level here. Until and unless that happens, no dice, this finishes to the downside, but it can take a while. The market's designed to absolutely drive you to drink. That's the way it works. Speaking of which, here's the chart of gold. If anybody's trying to trade gold, have a drink. I mean, we drop back below the important 1309 spot 50. Okay, we close below it, we stay below it the following day, and now we're back above it. So what's that trying to tell us? Is it trying to tell us that the bottom portion of this channel is going to break down, or is it not going to break down? Here's the bottom portion of the channel. Let me get my drawing tool out here. Here's the bottom portion of the channel, okay? When you want to call it there, call it here. It doesn't really matter where you call it. I happen to call it at 1309 spot 50 because that's where this pivot low was down here. So here's your bottom end of the channel. All right, now we're back above the bottom end of the channel, the top end of the channels, wherever you want it to be. It's in this range at the top end, somewhere in this neighborhood. So for this purpose here, what I'm saying is that this channel, it's fighting. You'll see tomorrow's close. Tomorrow's close is going to be extremely important. Where is the, I have to get rid of the lines. Where is gold going to close Friday's weekly close? Above or below 1309 spot 50? That's going to be an interesting one. Back above it, and we could start to work our way back to the top end or at least the middle portion of the channel. Close below it, and I think there's lower prices looming for gold. Crude oil, same deal in crude oil. Nothing's changed. What we did was exactly what we discussed was going to happen long before it happened, which is go sideways, eat some time off the clock, give the 20-period moving average or home base a chance to catch up to price, while giving price simultaneously a chance to drift lower and let home base catch up. Either way, they're going to meet at some point, and that will eat enough time off the clock and set crude oil up for another push higher, for another leg higher, working its way up to $73, $74 a barrel. I have repeated that so many times over the last few weeks that you can go back and listen to the videotape. This is exactly what it's doing. It was building a bullish pattern, and we were extended on the daily chart, a little overbought. Call it what you want. We were too far away from the 20-period moving average or home base. Market doesn't love to get too far away from home base. And what did it do? It went sideways and let home base catch up to price. Where did that happen? It happened right here. Where did we start talking about that? Who knows? We started talking about that probably back here. And I'm sure we did. And you can go back to the videotape to verify that. This is the way market, and I don't say that to do an I told you so. I say that to drive home the point that you can do this on any chart, in any market, any time frame. They all act and react the same way over and over and over again. And with that, folks, I think that's a wrap. That's everything I wanted to and intended to discuss today. So therefore, I'm going to give it a wrap. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.